Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Like the name suggests, this show gets you everything that you need to know about mutual funds so that you can make your investments with confidence. You see that number on your screen. If you've got specific questions for us related to mutual funds, then you can send them to us on that number. And the topic today that we're discussing has to do with multi-asset funds. And this is a category of mutual funds that is aiming at diversification. It believes in the philosophy that you should diversify not just within a particular asset class, that is in equity, but it should also allow you to invest in multiple asset classes. And usually this is in the form of investments into equity, fixed income, that is bonds, as well as commodities, and that can include something like gold or silver. And it can also include something like real estate. And some of these schemes invest in REITs. They can also invest in infrastructure assets. And we'll speak about what that entails and what you should bear in mind if you are indeed contemplating investing in these schemes. I'm going to be joined very soon by Vishal Dhawan of Plan Ahead Wealth, but I have Shalini Sekhri joining in right now. She's the Chief Executive Officer of Infinity Asset Advisor. Shalini, as always, thank you so much for taking the time. Let's start with what these schemes are meant to achieve and how large they are currently.
Hi, Alex. Good to be here. So multi-asset funds are a fairly recent category. In fact, some asset management companies have also converted some of their earlier strategies to multi-asset funds. Most of the schemes are in the range of 2,000–3,000 crores, one of the outliers being iProve, which is now a 30,000 crore plus fund. So the category is gaining traction. Like I said, fairly new. The primary objective of a multi-asset allocation fund is to be able to help those investors who might not have the wherewithal or the ability to choose the right asset class and toggle between them in the appropriate percentages, either because of lack of knowledge, time, etc. So that's where these funds, as you rightly already pointed out, have an allocation to at least 3 assets, 10% each being the minimum, and could go to various other asset classes, including commodities like gold and silver. They're even looking at international funds at this point of time. So there's a wide range of multi-asset funds, and different things suit different investors depending on their risk return profile.
Okay, but let's talk about the thesis of these schemes and what you think about that thesis, which is diversification. At its very core, that's the idea. And I was quite surprised, I must admit. I think this was a headline last year as well. If you look at the decadal performance of various assets, the asset that stands out is not equity, it is in fact gold. As somebody that tracks the equity markets on an ongoing basis every day, perhaps more than other people, this came as a bit of a surprise. And I think my mum was laughing at me quietly somewhere. But having said that, what about this theory and this thesis of having assets in several buckets?
Sure. So I think the basic premise of asset allocation is that many of these asset classes that we mentioned are not correlated, or in fact are inversely correlated. So what that really means is that there are lots of times where, say, equity is doing poorly, but because there's a flight to safety, gold as an asset class does extremely well. And if you look at the uncertainties in the world around us, if you do look at, say, the last 5–7 years, gold has been a preferred asset class, typically always been seen as a sleepy asset class that just beats inflation. But you're absolutely right. The world that we live in, the last some years, gold has been one of the best performing asset classes. On a 5-year basis, it's beaten the Nifty. On a 7-year basis, it's aligned to the Nifty, which is stunning by any standards. The point that I want to make here is that at different times, and if you look at various asset classes on, say, a calendar year basis, the top performing asset class literally changes every year. So how then do investors ensure that they have assets allocated to whatever happens to be, the current favorites of that given year? So that's where multi-asset funds come in, which basically play on the fact that there is a low correlation between certain asset categories, depending on whether it's a period where, high risk is something the world is looking at, or people are in a flight to safety mode. So that's where every year, if an investor wants relatively steady returns which are taking advantage of whichever asset classes are doing well at that point of time, that's really where the multi-asset funds come into play. So yes, diversification is what blunts volatility, blunts drawdown, and ensures that investors keep getting a steady return over periods of time. And as you rightly pointed out, it doesn't even mean that these are suboptimal returns. These could in fact be very equity-like returns, if the scheme does well.
And it goes behind the philosophy, don't put all your jalebis in one basket because they all could get stolen at one go. Vishal Dhawan, founder and chief executive officer of Plan Ahead Wealth Advisors, is joining me to talk about multi-asset funds. Vishal, I asked you about this before the show and you sent me some interesting talking points, one of which is that the category as a whole, it may not have seen a very sharp increase in assets under management, but at the same time, the number of offerings in the space has gone up quite substantially.
Oh, it certainly has. I think with the taxation change that happened a year ago, I think there was suddenly a sort of large number of multi-asset funds that got launched. And interestingly, the AUM has actually gone up close to 3 times during this period. So clearly that those new fund offerings did result in a lot of fresh money coming in as well. And I think it's important to keep in mind that a lot of this, in our view, has got actually triggered by tax sort of changes, which is not ideally why investors need to buy particular types of products, irrespective of all the merits that Shalini just explained about using multi-asset funds as a solution.
Okay. Now, let's drill down a little further and talk about how some of these schemes have operated and how nimble they are. Shalini, if you've studied the way that the fund managers have operated in some of these schemes, could you illustrate the way that the assets under the hood have moved and how they could potentially move based on certain events?
Sure. So one is, while I wouldn't like to delve into a specific scheme because,
Sure,
as Vishal mentioned, there are many out there, and each of them has its own characteristics. I think one of the key differences between a multi-asset fund and what we call a dynamic bond fund, a dynamic asset allocation fund, which we also call the balanced advantage fund, is that here there is a relatively steady state allocation to some of the asset classes. So, for example, many of them make a virtue of the fact that if they have at least 65% in equity at most points of time, it results in a very beneficial tax rate for the investor. Accordingly, if you look at some of the best performing funds out there today, you will find that they would be typically at least 65% in equity at most points in time. So that really is their stated philosophy. The intention is to have a meaningful allocation to all the asset classes. Of course, there is active management, and that's the reason that we go out to fund managers. And it is their job to kind of increase or decrease allocation. That having been said, I would say there is a broad range that each of the fund managers would generally keep in mind when they look at toggling between assets. So unlike, say, a balanced advantage fund or any of the other hybrid fund categories where there could be a massive change in the allocation, we generally find this a more stable asset class in terms of where the underlying is allocated.
Okay. Vishal, just to build on this point a little further, that 65% threshold being met because of equity taxation requirements, and just explain the point on when the taxation rules changed for fixed income and essentially why this prompted people to look at hybrid in more with more interest, and also then talk about how this 65% is usually constructed. What is the usual orientation in these schemes?
Yeah, so in March 2023, actually there was a change that came in where there was a classification which happened, which tried to break up how you need to look at the entire equities versus other asset taxation. So what happened is that if you had more than 65% in equity, you got long-term tax benefits at 10% if you held for more than a year, and you got 15% if you held for less than a year, which was short-term. Earlier on, before March 23, you were allowed to take indexation benefits on debt, on gold, on international investments. You were allowed to do all of that. as long as you held for more than 3 years. And then you got taxed at 20%. So effectively, with the indexation benefit that came with it, your effective tax rate may have been anywhere between 10 to 15% a year. So what happened in that period of time, post March 23, is that suddenly equity became a much more attractive asset class if you were more than 65% from a tax perspective. However, if you had more than 35% in equity, you could still get the indexation benefit of long term if you held for more than 3 years. And therefore, you started to see multi asset funds come in two buckets. One is those which have more than 65% equity, and then those which have between 35 and 65% equity, so that they can remain a little truer to label saying that we are really multi asset, because our equity exposure is not likely to be like 65%, but is likely to be maybe 35-40%. And therefore, we can behave in a manner which is much more balanced. Because what you need to remember is this multi asset category also coexists with two other categories. One is the balanced advantage fund, which can have anywhere typically between 30 to 80% in equity, depending on the fund manager's view and the mathematical models followed. And on the other side, there are also hybrid aggressive funds, which typically have very often between 65% and 80% equity exposure. So I think for investors, the primary question was that what do they want their fund to actually do for them? Are they really looking at multi asset, in which case they'd like to be in funds where there is actually much better representation of all these three asset classes, equity, gold, and debt? Or are they wanting the taxation benefit to override everything else and therefore go to funds that have more than a 65% exposure?
That's a fair point. And in fact, it is an important question to ask as well, because usually you would compare products. There are so many out there. They each perform a certain function. Shalini, between an aggressive hybrid, which is essentially mostly equity, or as you pointed out, dynamic asset allocation as well, which has a significant portion in equity, and a multi-asset, all of which are hybrid schemes, which one would you buy, and what would make you choose one over the other?
To just look at the past data, Alex, I am seeing that the multi-asset category, possibly because of the fact that allocation to gold is always fairly core, has done very well in the last 5-7 years. But that's in a way just anecdotal, right? That's the past few years. So to my mind, as Vishal also pointed out, it's very critical for us to understand that what really is the underlying exposure that you want. I think there are 3-4 categories of investors for whom multi-asset makes a lot of sense. One could be beginners who want to learn about various asset classes and understand why a fund manager is doing what he's doing. Secondly, could be retirees, because they are often, requiring a fairly steady state kind of a return and income. They do not want to see capital erosion. It could also be for very busy people who themselves do not have the wherewithal to look at various asset classes. So equity can be played in many ways, including the other two product categories we discussed. But I think for someone who is actually looking at exposure to various asset classes at most points of time, and the returns as well have proven the fact that it makes a lot of sense, I would say the multi asset allocation bucket, to my mind, for these kind of investors would be a pretty good pick.
Vishal, does this do away with the requirement of doing your own allocation? Because that would entail putting all of your money into one fund, which, okay, fine, is multi-asset, but there is risk associated with doing that as well.
Absolutely. In fact, I think we need to keep in mind that there is a limited track record that multi-asset funds really have in India. So there isn't a lot of data to go by, unlike standalone equity funds, debt funds, where you can actually look at a lot of history, do a lot of analysis, do number crunching, look at whether risk is got well managed, etc. So I think when you buy multi-asset funds and they're part of a larger portfolio, you need to keep in mind that they're only solving a part of the problem. They're not solving your need to have other funds in there. So we continue to believe that investors need to think on whether they want their entire portfolio to be multi-asset, for which they probably need confidence that what you've seen in the last 5 years is actually transferable over the next decade, 2 decades, depending on how long they want to invest, or whether they think it's too early to make those kind of decisions. If that's the case, then obviously what they want to do is, try to find funds with relatively good track records. Obviously, there are risk ratios that are available, etc., that you can build into your multi-asset choice. However, it's more likely that you're going to end up finding that you will want to build this individually, especially if you're very tax conscious, because there may be instruments that are available, like sovereign gold bonds, for example, that give you gold in a more tax efficient structure than even the 10% that you're subject to if you went to a multi-asset fund, which has more than 65% equity, as long as you're comfortable with the lock-in of a sovereign gold bond. Similarly, if you look at equity and debt, you could find maybe 5 or 7 schemes which have great track records. Maybe some of them are just tracking indexes, some of them are actively managed funds, similarly on the debt side. So essentially, a portfolio could be far more balanced, as long as you're not one of those people who will, just forget it. Because, like Shalini mentioned, if you're so busy or you don't understand what's happening, then maybe just the basket works well for you because you don't have to break your head too much about it. But if you are an active investor, have an advisor, some of those things might be very useful for you to then construct more rounded portfolios, which can actually be very tax efficient as well.
Fair point. Just a final question on this category. There are a few people that believe very firmly in gold. Shalini, we spoke about that at the start. For those that don't have an allocation, would you buy something like this just for the allocation that it has in gold?
I don't think so, Alex. Firstly, I'd like to point out I don't think your mom's gold jewelry is an asset because she's never going to sell it, right?
I keep telling her that. She doesn't listen to me.
Exactly. So, but jokes apart, gold as an asset class, I think for us, for various reasons, is an important allocation. In fact, as Vishal pointed out, if a multi-asset fund is just say 10-15% of your portfolio, and within that gold is one small allocation, it's really not that meaningful to the overall portfolio. So I do believe for someone who has the wherewithal to look into it, gold will continue to have meaning, especially in the kind of world we are living in. And I believe, 2-3 key reasons for that. So one is we are seeing central bankers look more and more to gold, as the option of choice when they are building their reserves. So I think that's something that's going to keep fueling demand. Secondly, it's also a way to hedge against currency debasement. So I think that's something, again, where gold will keep finding favor. And I think if you look at it, it's one of the truly uncorrelated assets to the rest of your portfolio. And when anyone, and Vishal, I'm sure will concur, when you're building a overall portfolio theory clearly says that having uncorrelated assets, which means that when one asset class is falling, the other one actually does well. And therefore gives you that much needed return in a year where perhaps equity is doing poorly. So if you look at years like 2008, 2011, 2020, equity in complete disarray, you've had gold giving you returns anywhere from 25 to 30, 32%. So clearly, I think there will, in the days that we are in, where there is volatility, there is risk, there's geopolitical tensions, I think gold is an important asset class, and I don't think we can really do away with that or just make do with the small percentage that will come from your multi-asset fund.
It's time to start taking a few of the queries that have come in while I was speaking. And in case, by the way, you have more queries, you can send them to us on the number that you see on the screen right now. The first question we're taking is from Ravneet, and he is 29 years old. He is investing in the Motilal Oswal Mid-Cap Fund. He's currently putting in 4,000 rupees per month. And if he had started investing in this scheme maybe about a year, year and a half, 2 years back, then he's done quite well indeed. Vishal, this is one of the best performing mid-cap schemes out there right now, and I'm hopeful that he has been investing for some time and he hasn't just started investing based on the recent performance. What would you say about his selection though?
So I think it's clearly done well in the more recent past. I think what investors need to be mindful of, like Ravneet, he's 29, so he hopefully has a long investment horizon. I think investors today need to be mindful of the fact that both mid and small caps are very, very expensive if you look at it from the lens of historical price to earnings multiples, for example. And therefore, there is a fairly large chance that they could end up having to run through periods where there will be sharp corrections in mid caps and small caps as well. And they have to be comfortable with the fact that they continue with their SIPs during that period as well. It's much easier to, buy a mid cap and small cap fund when it's doing well and sort of continues to do well, and your SIP keeps showing more and more value every year. But it gets hard when there's a very sharp correction and everyone around you seems to talk about some sort of a doomsday scenario. So I would say that if Ravneet's clear that this is going to be an SIP that he's going to run for 10 to 15 years, then it's a good choice. I think he needs to track performance of the fund at least once a year to see that it's sort of remaining on track and doing well. But I think if you have a 10 to 15 year investment horizon, I think at Ravneet's age, mid and small cap funds can actually work.
And not to put words in your mouth, but to round that up perhaps with a couple more funds to have a more holistic view. And you've said it so many times, so I'm taking the liberty of saying it for you. But the last question we're taking is Akash Wagmare. He's 25 years old. He has an intention of building a house in the next 5 years. I do not know where this house is, so I do not know what the budget is, but he's looking at investing over about 6,000 rupees monthly for the next 5 years. What schemes can he look at? He's quite young. So would you say that mid and small cap works here as well, Vishal?
So I think what happens here is his time frame is much shorter. He's only looking for 5 years, and if the flexibility to buy this house is not really there, I think mid and small caps are not really sort of his answers. And one of the very, very important things to keep in mind is that when you run an SIP for 5 years, your effective holding period for your entire portfolio is going to be only half of that, which is 2.5 years, because your first installment will finish 5 years, but the last installment will probably finish only a month before you need the money. So if the intent is to just have a 5-year investment horizon through an SIP, then actually just a pure equity fund itself may not be the option. One would need to look at balanced advantage funds, for example, which could become, which could move dynamically between equity and debt. And at a 2.5-year effective investment horizon, though it appears to be 5 years, one can get the benefit of, some of that averaging that happens. And one of the very, very important considerations, so I think just keep in mind that balanced advantage funds are not all the same. They may appear to be the same because of the way that they are named, because they come into a particular category. But you do have those which are sort of more fundamentally driven, and those which use sort of trend indicators in the way that they are constructed. And therefore, ideally, one balanced advantage fund from each bucket might be a good choice for investors to look at.
Do you want to make a couple of suggestions?
So I think on the fundamental side, one can look at funds like HDFC or ICICI. Both of them follow that sort of a model. And if you look at more sort of trend-based models, then Edelweiss is an example of a fund which follows that. So those are examples of funds that investors could look at. Obviously, they need to look at it in their own sort of personal portfolio in the way that it fits their needs.
Yeah, definitely. Don't look at this as a recommendation, please. This is something to help you on the way to selecting funds, and please consult your advisor, is what we always say on this program. Shalini as well as Vishal, thank you so much for joining us on this program. It's been a pleasure, as always, speaking to you.
Thank you so much.
Thanks, Alex.
All right, that brings us to the end of this particular edition of the Mutual Fund Show. It's been an absolute pleasure bringing it to you. Do stay tuned, lots more coming up over the course of the day. And this is NDTV Profit.